You need to stop what you're doing right now and pay attention, because what just happened in the silver market is not what they're telling you it is. On January 30th, silver crashed 31% in a single day, the second worst collapse in recorded history. It went from $114 down to $78 in a matter of hours, wiping out months of gains while everyone watched in disbelief. And if you think that was just normal market volatility or profit-taking after silver hit $121 the day before, you're missing the entire picture. This was deliberate, this was orchestrated, and this was the opening move in a much bigger game that bull's going to determine whether you protect your wealth or watch it evaporate over the next year. 3 days ago, President Trump nominated Kevin Warsh to chair the Federal Reserve. The second that news broke, precious metals didn't just fall, they collapsed. Gold dropped 12% in its worst day since the early 1980s. Silver got obliterated, losing a third of its value. As of today, February 2nd, silver is trading around $79 per ounce. Let me put that in perspective for you. Just 4 days ago, silver was at $121. 1 week ago, people were talking about $150 silver, $200 silver, a supply crisis that couldn't be stopped. And then with one announcement, one name, the entire rally got cut off at the knees. Now here's what you need to understand before we go any further. Hit that subscribe button right now, because what I'm about to explain is not being covered anywhere in mainstream financial media. And you need this information if you're holding silver, if you're invested in precious metals, if you're trying to protect yourself from inflation and currency debasement. Click subscribe, turn on notifications, and then drop a comment below telling me where you're watching from and what time it is where you are. I want to know if you saw this crash coming, if you got caught in it, if you're still holding physical metal, or if you panicked and sold. Comment section, let me know, because we're all in this together, and the more we share information, the better we can navigate what's about to happen. Next. Alright, let's get into what actually happened here. On January 30th, rumors started circulating that Trump was about to announce his Fed chair pick. Silver was trading north of $114 at the time, riding one of the most explosive rallies in modern history. Then the announcement came. Kevin Warsh, former Fed governor, known inflation hawk, the guy who spent the last decade arguing against quantitative easing and easy money policies. The market reaction was instant, and it was brutal. The dollar surged, treasury yields spiked, and every commodity on the planet got hammered, with silver taking the worst beating of all. But here's where it gets interesting. Within hours of that crash, the CME Group, that's the exchange that runs the futures market, announced they were raising margin requirements on silver and gold by 33%. This is the second margin hike in 3 days. What that means in plain English is, they made it more expensive to hold leveraged positions in precious metals, which forced traders who were borrowing money to buy silver to either put up more cash immediately or get liquidated. And guess what happened? Massive forced liquidations. Algorithms kicked in, stop losses got triggered, and you got a cascading waterfall of selling that drove the price from $114 down to an intraday low near $75 before it recovered slightly to close the day around $78. Now if you're sitting there thinking, this sounds familiar, you're right, because we've seen this exact playbook before, and it happened in 1990% with a guy named Paul Volcker. Let me take you back, because understanding that history is the key to understanding what's about to happen now. In 1979, gold and silver were exploding higher. Inflation was running rampant. The dollar was losing credibility. Everyone was piling into hard assets because they didn't trust paper currency. Gold went from $200 to $850 in less than 2 years. Silver went from $6 to $49. It was mania. It was panic buying. It was exactly what we just saw in January 2026. And then Paul Volcker became Fed chairman. Volcker was brought in with one mission: break inflation at any cost. He jacked interest rates up to 20%. 20%. The economy went into a severe recession. Unemployment spiked above 10%. And precious metals, they collapsed. Gold crashed from $850 and didn't get back to that level for nearly 30 years. Silver crashed from $49 and spent decades in the wilderness. The entire precious metals bull market got destroyed by one man's willingness to tighten monetary policy so aggressively that it crushed everything in its path. Kevin Warsh was a Fed governor during the 2008 financial crisis. He watched what happened when the Fed printed trillions of dollars. He argued vocally against it. He wrote op-eds warning that quantitative easing would lead to inflation and asset bubbles and systemic instability. He built his entire reputation on being a hard money guy, someone who thinks the Fed's job is to protect the value of the currency, not to inflate asset prices and bail out Wall Street every time there's a problem. This is not speculation, this is public record. You can go read his speeches, his essays, his congressional testimony. The man is a hawk and everyone knows it. So when Trump nominates this guy to run the Federal Reserve, what message is that sending to the market? It's telling you that rates are going higher, not lower. It's telling you that the dollar is about to get stronger, not weaker. It's telling you that commodities, especially precious metals that rally when people lose faith in fiat currency, are about to get crushed because the government just signaled they're willing to defend the dollar with everything they've got. And that's exactly what happened. The moment Warsh's name hit the wire, the dollar rallied. Precious metals collapsed, and trillions of dollars got wiped out of commodity markets in a matter of hours. Now here's where this gets really concerning. And this is what I want you to pay close attention to. The timing of this announcement was not random. Silver had just hit $121 per ounce the day before, an all-time record high. Gold was above $5,600, also an all-time high. The entire precious metals complex was stretched, overbought, running on momentum and speculation. It was the perfect moment to pull the rug out. And that's exactly what they did. You don't announce a hawkish Fed chair when metals are already falling. You announce them at the peak, when it creates maximum psychological damage, when it flips sentiment instantly, when it triggers the most pain for the most people. Think about who benefits from this. The US government is drowning in $37 trillion of debt. They need low interest rates and a weak dollar to inflate that debt away. But they also can't let precious metals run to $200, $300, $500 per ounce, because that destroys confidence in the dollar itself. It tells the world that people don't trust paper currency, that they're fleeing to hard assets, that the system is breaking. So what do? You manufacture a crash. You nominate someone whose mere name causes the market to reprice everything. You coordinate with the exchanges to raise margins and force liquidations. You create a controlled demolition that looks like natural market forces, but is actually a policy intervention designed to protect dollar hegemony. Let me show you the mechanics of how this worked, because this is important. When the Warsh announcement hit, the dollar index spiked. A stronger dollar makes commodities more expensive for foreign buyers, which reduces demand. At the exact same time, commodity currencies like the Australian dollar and Canadian dollar, which tend to move with metals prices, got hammered. Then the CME raised margins, which meant anyone holding futures contracts on leverage either had to deposit more cash or get liquidated. Most people in that situation don't have extra cash sitting around, so they got forced liquidated. Their positions got closed automatically, which creates selling pressure. That selling pressure triggers stop-loss orders from other traders, which creates more selling. And then the algorithms that trade based on momentum see the price falling, and they pile on with more selling. What you end up with is a liquidation cascade, where one event triggers another, which triggers another. And the price goes into freefall, not because fundamentals changed, but because the structure of the market itself amplifies the move. This is exactly what happened on January 30th. Silver didn't fall 31% because industrial demand disappeared, or because suddenly there's no supply deficit, or because China reversed their export controls. Silver fell 31% because the US government made a policy decision, signaled it through a Fed chair nomination, and then the market structure did the rest. Now I know some of you are thinking, okay, but this is just short-term volatility. Silver is still way higher than it was a year ago. The fundamentals haven't changed. The supply deficit is still real. Industrial demand is still growing. China still has export controls. All of that is true. But here's what you're missing. The Volcker moment in 1980 didn't just cause a temporary pullback. It ended the entire bull market for 30 years. When Volcker jacked rates to 20%, he broke inflation, but he also broke the price of gold and silver for a generation. People who bought silver at $40 or $45 in 1980 spent the rest of their lives underwater on that investment. They never got back to break even. Is that going to happen again? I don't know. But what I do know is that if Kevin Warsh gets confirmed and he follows through on his historical policy positions, we are entering a very different environment than what we had in December and January. When silver was running to $120, a hawkish Fed means higher real interest rates. Higher real interest rates mean a stronger dollar. A stronger dollar means weaker commodity prices. It's that simple. And if Warsh decides he's going to follow the Volcker playbook and prioritize crushing inflation and defending the currency over everything else, then precious metals are going to struggle, potentially for a long time. Here's the part that really concerns me. The physical silver market fundamentals have not changed. There is still a massive supply deficit. Industrial demand is still growing. China is still restricting exports. COMEX registered inventory is still dangerously low. All the reasons that drove silver from $30 to $120 are still in place, but none of that matters if policy intervenes. The paper market, the futures market, the leverage market, that's where price gets set in the short term. And if the government can manipulate that market through Fed policy, through margin hikes, through coordinated interventions, they can suppress the price even if physical fundamentals are screaming higher. This is the great disconnect that happens in precious metals. You can have a physical shortage. You can have premiums on coins and bars going through the roof. You can have delivery delays and empty dealer shelves. But if they can control the paper price through the futures market, that's what everyone sees quoted on the screen. And when the paper price crashes 30% in a day, it doesn't matter that you can't actually buy physical metal at that price. The psychological damage is done. People panic, people sell, people lose faith, and the rally gets killed. So what does this mean for you? First, if you bought silver above $100, you're sitting on losses right now. The price is at $79 as of today. You need to decide whether you believe this crash was policy-driven and temporary, or whether it's the beginning of a longer-term bear market, like what happened after 1980. That's not a decision I can make for you, but you need to understand what you're dealing with. This wasn't a normal correction. This was a policy intervention designed to protect the dollar and kill the precious metals rally. Second, if you were planning to buy silver and you're wondering if this is your chance, you need to think about what kind of Fed chair Kevin Warsh is going to be. If he's confirmed and he follows through on his hawkish reputation, the next 12 to 24 months could be very difficult for precious metals. Real interest rates could go significantly higher. The dollar could strengthen substantially. And even with all the physical fundamentals supporting higher prices, the paper market could keep silver suppressed. On the other hand, if Warsh turns out to be more dovish than expected, if Trump pressures him to cut rates, if the policy environment shifts, then this crash could be the buying opportunity of the decade. Third, and this is the most important point, you need to understand the difference between physical silver and paper silver. If you own shares in an ETF like SLV, you own paper. If you own futures contracts, you own paper. If you own mining stocks, you own paper. And when paper markets get manipulated through policy interventions and margin hikes and coordinated crashes, paper gets destroyed. Physical metal is different. Physical metal is real. It's in your hand or in a vault under your control. It can't be margin called. It can't be force liquidated. It doesn't care what the CME does or what Kevin Warsh says. It just sits there, holding its value in the real world even if the paper price is being manipulated. This is why I keep coming back to physical ownership. The crash on January 30th wiped out leveraged traders. It destroyed paper positions. It crushed ETF holders. But if you own physical silver that you bought at $30 or $50 or even $70 and you're holding it in your possession, you didn't get forced to sell. You didn't get margin called. You didn't get liquidated. You just watched the paper price crash and you made a decision about whether to hold or sell, and if you held, the metal is still there. That's the difference between paper and physical. And it's a lesson that gets taught over and over again every time there's a major market event. Now let's talk about what happens next, because that's what really matters. Kevin Warsh has been nominated but not yet confirmed. The Senate has to hold hearings, ask questions, vote. That process could take weeks or months. In the meantime, Jerome Powell is still the Fed chair, and his term doesn't end until May 2026. So we're in this strange interim period where the market is pricing in Warsh's future policy, but actual policy hasn't changed yet. This creates uncertainty, and uncertainty creates volatility. If Warsh's confirmation hearings reveal that he's more dovish than his reputation suggests, If Trump has convinced him to prioritize growth over inflation control, if the policy stance is actually going to be looser than the market is currently pricing, then precious metals could bounce hard. Silver could rally back toward $100 or higher. The crash could end up being a false signal, a head fake that shook out weak hands before the next leg higher. But if Warsh doubles down on his hawkish views, if he makes it clear that he's going to fight inflation aggressively, if he signals higher real rates and a strong dollar policy, then the pain could continue and we could see silver fall further before it finds a bottom. The other wildcard here is Trump himself. Trump has been extremely vocal about wanting lower interest rates. He's criticized Powell for keeping rates too high. He's argued that the economy needs easier money, not tighter money. So why did he nominate a known hawk to run the Fed? There are a few possible explanations. One is that Trump is playing a longer game, where he nominates Warsh to crash commodities and strengthen the dollar. And then once Warsh is confirmed, Trump pressures him to cut rates anyway. This would give Trump the political cover of having nominated a credible, independent-minded Fed chair, while still getting the policy he wants. Another explanation is that Trump's priorities have shifted. Maybe inflation is becoming a bigger political problem than he expected. Maybe he's worried about the dollar losing its reserve currency status. Maybe he's decided that defending dollar hegemony is more important than short-term economic growth. Or maybe, and this is the explanation I think is most likely, the crash in precious metals was the goal. Trump and his advisors saw silver at $121, gold at $5,600, and they recognized that this was becoming a problem. People losing faith in the dollar, fleeing to hard assets, talking about the end of fiat currency. That's dangerous for the system. So they intervened. They nominated Warsh, they signaled a policy shift, and they crashed the market intentionally to restore confidence in the dollar. If that's what happened, and I think the evidence strongly suggests it is, then this was a calculated move. It wasn't random. It wasn't coincidence. It was deliberate policy action designed to kill the precious metals rally and protect the dollar. And if that's true, then you need to be very careful about what you do next, because if the government is willing to intervene this aggressively, if they're willing to crash markets by 30% in a single day through policy announcements and margin hikes, then they can do it again. They can do it every time silver rallies too high. They can suppress the price indefinitely, as long as they control the paper market and as long as people are trading on leverage in the futures market. This is the ugly reality of commodity markets. They can be manipulated, they can be controlled. The government and the big banks and the exchanges all have tools they can use to engineer price movements when it serves their interests. And when those tools get deployed, regular investors get crushed. The people who bought silver at $115, thinking it was going to $150 or $200, they just lost 30% or more of their investment in a single day. The people who were trading on leverage got wiped out completely. Their accounts went to zero. Their positions got liquidated. They lost everything. But here's what's interesting. Despite the massive crash in the paper price, reports are coming in that physical silver is still in high demand. Dealers are reporting strong buying. Premiums on physical coins and bars haven't collapsed the way the paper price did. There's a disconnect forming between paper silver at $79 and physical silver that is trading with significant premiums over spot. This is exactly what happens when the paper market gets manipulated but the physical market fundamentals remain tight. The two prices start to diverge. And that divergence tells you something important. It tells you that the paper crash was artificial, that it was policy-driven, not fundamentally driven. The question is whether that disconnect can persist. In a normal market, arbitrage keeps paper and physical prices aligned. If physical is trading at a premium, then traders can buy paper, take delivery, and sell physical for a profit, which brings the prices back together. But if physical supply is constrained, if delivery is difficult, if premiums persist, then that arbitrage breaks down. And when it breaks down, you can have paper trading at $79, while physical is, effectively, $90 or $100 or higher, depending on what form you want and where you're buying it. This happened in March 2020. It happened during the 2011 peak, and it's starting to happen again now. So here's my take on all of this. The crash on January 30th was engineered through policy. The Warsh nomination was timed to inflict maximum damage on the precious metals rally. The CME margin hikes were coordinated to force liquidations. The dollar surge was intentional. This was not a natural market event. This was intervention. And if you understand that, then you can make better decisions about what to do next. If you're holding physical silver, I would not panic and sell into this crash. The metal hasn't changed. The supply deficit hasn't changed. The industrial demand hasn't changed. What changed was policy, and policy can change again. If you're trading paper silver on leverage, you probably just learned a very expensive lesson about counterparty risk and manipulation risk. If you're thinking about buying, I would wait to see what Warsh says during his confirmation hearings. I would wait to see whether Trump continues to push for rate cuts, or whether he's actually going to let Warsh tighten. I would wait to see if silver finds support at these levels or if it's going to fall further. Because if this really is a Volcker moment, if we're entering a period of aggressive monetary tightening and dollar strength, then there could be more downside ahead. But if this was just a policy headfake designed to shake out speculators and weak hands, then buying physical silver in the 70s or 80s could look brilliant a year from now. What I can tell you with certainty is this: the game has changed. The rally that took silver from $30 to $121 is over, at least for now. The policy has intervened. The Fed chair nomination was the circuit breaker that stopped the rally in its tracks. Whether this is a temporary pause or the start of a longer bear market depends entirely on what Warsh does when he takes office in May, and whether Trump allows him to follow through on his hawkish instincts or pressures him to cut rates. That's the key variable. Everything else is noise. In the meantime, I would focus on the fundamentals that you can control. If you believe in physical metal as wealth insurance, as a hedge against currency debasement, as protection against systemic risk, then own physical metal and don't trade it based on short-term price movements. If you're speculating on price, if you're trying to time rallies and crashes, if you're using leverage, then understand that you're playing in a manipulated market, where policy can intervene at any time and wipe you out. The choice is yours, but make it with your eyes open. The silver crash of January 30th, 2026 is going to be studied for years. It's going to be compared to 1980, to 2011, to every other time the government stepped in to defend the dollar by crushing precious metals. The people who understand what happened here, who see through the manipulation and recognize the policy intervention for what it was, those people are going to make better decisions than the ones who think this was just a normal correction or profit-taking. This was Trump's Fed gamble. He nominated Warsh to kill the rally, and it worked. Now we wait to see what happens next. Make sure you're subscribed so you don't miss updates on this story. Leave a comment telling me what you think, whether you're buying or selling at these levels, whether you believe this is a buying opportunity or the start of something worse, and most importantly, stay informed, stay skeptical, and don't trust the mainstream narrative. What they're telling you and what actually happened are two very different things, and understanding the difference is how you protect your wealth when everything else is breaking. That's it for today. I'll see you in the next one, where we'll keep tracking this Warsh confirmation, what it means for precious metals, and whether Trump really did just engineer the biggest policy-driven crash in modern silver market history. Stay sharp, stay safe, and hold on to your physical metal because nobody can margin call what you hold in your hand.